How you doing, everybody? My name is David Mauch. I'm the Development Director at Habitat for Humanity of Greater Dayton. Thanks for joining us today for a great session on donor giving strategies with myself and then also Dan Johnson. Uh, Dan is at Birchcreek Wealth Management and also a board member here at Habitat for Humanity of Greater Dayton. And I we were just talking before we got the call started. Want to give a shout out to Penny Morris, who is a little bit of inspiration for this as well. Penny just rotated off our board last year and has been an amazing person to work with over at least 10 years of my tenure. And when Dan and Penny were sharing some ideas back and forth, and Penny said this would be a great piece of information to bring to the masses. So thank you, Penny, for thinking it was a good idea and being on the call today. And we miss you here a little bit at Habitat. I know you're just a call away though. So thanks to all. We're going to share a little bit about Habitat for Humanity and the work that we do in the community. And then I'm going to turn it over to Dan to give a good number of minutes on some strategies, especially this time of year. One of the things that I know in the development department here at Habitat is about 75 to 80% of individual giving people giving gifts to our organization give those gifts in November and December. So really focused on year-end giving, and so very timely, and it's a great time that we see that people take advantage of the chance to give a couple bucks, to support Habitat for Humanity and our work in the community. So thank you, and appreciate you being on the call today. So a little bit about us. We are here in Montgomery. We serve Montgomery, Clark, and Greene counties. we're the oldest affiliate in the state of Ohio. We've been working. We're coming up on our 42nd year of working in the community, of providing opportunities for people to have safe and affordable housing. We do that through a couple different methods, which I'll share out. But really proud of our work. we're getting close to building our 400th house, building and selling our 400th house. And we've also, over the last few years, gotten really heavy in the critical repair space. So doing a lot of critical repairs for older adults in particular. You see our mission statement there, seeking to put God's love into action. Habitat for Humanity brings people together to build homes, communities, and hope. And I think when I think about that statement, the thing that jumps out is bringing people together. We can't do anything by ourselves. Everything we do is because of partnerships and because people in the community support our work and believe in what we're doing. So I always like to think of Habitat for Humanity as we're just a vessel for people to come alongside and work with to do great work and support people in the community in a variety of ways. Think about when people think about Habitat for Humanity, what I always find, and I talk to tons of people in the community, is they know we do something as far as building houses, and they usually bring up Jimmy Carter. And those are the two things that people know about Habitat for Humanity. So I always like to think people know our brand, and thank you to President Carter for that. And people know we do something around housing, but they're really not 100% sure how the nuances of the program come together. The first thing, whenever I'm talking to folks, is that a myth I think that I want to dispel is, we do not give houses away. We build homes, and we're really proud of that. You see a few of our homes displayed here on the PowerPoint presentation, but we do not give those houses away. What we do is we sell those houses to families that partner with us for the opportunity to buy a house, and we sell the houses for more or less their appraised value, and we sell them with a 0% interest mortgage payment. We're on a call today talking about donor strategies and kind of finances and things. So it's not hard to understand the power of the 0% interest mortgage payment. It literally is saving people hundreds of thousands of dollars off the cost of purchasing a home. There's a real, pride in that what we do is, give people the opportunity that, if they had to go through a traditional means to purchase a house, that may be out of reach. by working with us and working really hard with us for a year or more, they have the chance to get into home ownership at a cost that's affordable to them and accessible to them. So really proud of that. But as I said, really want to make sure people understand we do not give anything away. These homes are purchased. They're just purchased with a 0% interest mortgage payment. So that's what makes it accessible and affordable for the families that work with us and get accepted into our program. Mentioned the building communities. Everything, like I said, everything we do is about partnership. We have so many amazing partners in the community. I was just talking to Dan. I had just because it's front of mind, we had a great meeting yesterday with Wright State University. They want to get involved with us in 2025. We've got an extensive and robust partnership with the University of Dayton. Some other great partners. CareSource has been an amazing partner of ours for a number of years. Centerpoint Energy, we've got a build going thanks to their support up in Trotwood that's about to kick off. We're working with Dayton Youth Build up in Clark County. We've got a great partnership kicking in with Springfield CTC to bring workforce development initiatives to some of their students to help us build a home. So it's and then beyond that though, as much as I love to talk about some of the bigger branded stuff that we do and the bigger things that people have heard of these entities, I also really understand that even more than that, it's individuals that get involved with our organization and support our organization every year. And you see it on your screen here. The volunteer support we get from the community is just amazing. I mean, it's the people come out on a day off or on a weekend or as a team with a business and do team building activities, helping us to build these homes is amazing. And we can't thank you enough. It's so gratifying that the people not only donate, but donate their time and donate their skills to our organization. So nothing happens without partnership here at Habitat for Humanity, and we're just really grateful to have some great community support and amazing partners. Mentioned the volunteerism, and our volunteer sites are open Tuesday through Saturday. Get a lot of great feedback from that work, and people really seem to enjoy themselves. It may help us extend our abilities and the chance to serve people in the community. And it's also just a great team building. I see two things when I think about our volunteers. One, it's companies and corporations that, they want a team building experience. They want to get out of the office or get away from their place of employment and get out in the community and do something positive. And so we're a great chance for them. I also see a lot of retired people that come out and volunteer with us, which we are really grateful for. I'm not retired, but I imagine one day I hope to be. And it's when you get, you don't want to just sit around all the time. So having a chance to get out of the house, 1 or 2 days a week or something. I see some people coming out 5 days a week, and do something positive and help out. Really just those are the volunteers that I see. Those retired folks that want to just come out and do something positive and have some fun. So, as I mentioned previously, we built 400 homes. We've been in existence since 1983. I mentioned this. Our partner families. It's not a giveaway program. It's a partnership program. You see a photo here. This is our Flyer Nation Bill dedication ceremony that happened a few weeks ago. I have this picture in my office. It's one of my favorite. When I look at this photo, I just see so many really great people from our community that came together to help us build this house. You've got Dr. Spina from the University of Dayton. You got the mayor of Dayton, Mayor Mims, Elizabeth Breitenstein, who's the market president for Fisher Homes. She chairs our Women Build initiative. Maria Rutherford-Wrong, who's the community engagement specialist with the Fifth Third Bank. You see Alicia there in the middle, Alicia Jackson. She's the homeowner. Debbie Lieberman, Commissioner Shaw. So Carolyn Rice, so many amazing people in this photo. It kind of encompasses what we're all about. It's about a community coming together to raise up, elevate, allow somebody to realize their dream of home ownership. And again, it's not a giveaway. It's a partnership. Alicia Jackson, you see in this photo, holding the keys next to her mom. She did at least 275 hours. Actually, I know in Alicia's case, she did more than that. She also attended 60 hours of classes to prepare her for home ownership. So it is absolutely 100% a partnership, and the people work really hard to get to the point where they can purchase their first home. Um, would be remiss if I didn't mention our critical repair program. This is a space that's really accelerating and has accelerated in the last 5 years, coming out of the Memorial Day tornadoes. That was the catalyst for us really getting a repair program up and running. We were instrumental in helping the community and the region bounce back from the tornadoes, doing many, many repairs. And once we saw the power of that work, we decided that it was something we wanted to lean into wholeheartedly. So over the last few years, we've done close to 200 critical repairs. Almost all of these, I'd almost say all of them, are being done for older adults who own their home and are on a very moderate to low income and need help keeping that home stabilized and staying in the house. Some use the term aging in place. If you're just on a Social Security income, this is who our clients are. With a $15 to $20 to $25,000 annual income, it can be difficult to make ends meet. And if you've got a repair that's needed, like a new roof or you're in a wheelchair now, you need your bathroom modified, you need a wheelchair ramp, you need a new furnace, you need a new water heater. Those are big ticket items. And if you're on a limited income, those are going to be hard to figure out. So we come in and we do those repairs free of charge for the homeowners, thanks to the generosity of our donors. We stabilize that house. We stabilize their ability to live in that house. We allow them to continue to have that house as an asset in their family, to pass that on generationally if they choose to do so, or sell it. The cost of assisted living in this country right now, on average, is $47,000 a year. That's on average. So to be able to allow older adults to stay safe and healthy in the home that they live in, that they own, is powerful, and it saves them money. It allows them to keep money in their pockets and stay where they want to stay, which is in their home. So really excited about what we've been able to do in this space, and it's getting more and more needed. And we are seeing more and more, people are contacting us more and more, wanting help in this realm, and where we can, and we've been able to put together some great partnerships with many entities in order to provide that service to the community. With that, I want to turn it over to one of our board members, one of my favorite board members. Not to say I'm ranking anybody, but Dan has been an incredible resource for us here at Habitat for Humanity of Greater Dayton. He's a great person and has done a lot to educate me on some giving strategies, and now he's going to share some opportunities, things to be thinking about moving forward. And thanks for joining us, and I'll turn it over to Dan. And I'm going to hit stop.
Thanks, Dave. And I'm going to try to go ahead and share my screen here. We had some reports that some folks couldn't see your screen. I could see you, hear you, and see your screen. So let me know, Dave. Can you see the screen okay?
Yes.
Okay.
Sorry about that on my part.
Okay. Hopefully this will work. So just to piggyback, folks, on what Dave was saying, I've been a board member for Dayton Habitat for about 8 years. In fact, they are going to kick me off next year. I've hung around so long. I'm going to term out three-year terms. And so I will term off the board. And it's just been such a wonderful way to learn more about an organization doing all these great things. I've been involved in a range of areas of the affiliation, including field operations, development, gala, strategic planning initiatives. So, and all that experience, I think the best way to really get to the heart of it is to go to a home dedication. And Dave mentioned that there's a home dedication this Friday. It's where this hardworking family, oftentimes first generational homeowner, oftentimes coming from a really in some cases not safe situation, into this new home where they have pride, they have the ability to pass on, some wealth to the next generation. And that's where the rubber hits the road, I think, is seeing the keys handed over to this family that's, scrimped and save a modest down payment in relative terms, and put so many sweat equity hours into getting into their home. So in addition to serving on the board of Habitat, professionally, I founded Birchcreek Wealth Management about 5 years ago after spending time with a major Wall Street bank, close to a decade. And we are a team of 5 managing about $250 million for 180 client families. And we're a little different out in the financial advisory space. One, we're very focused on planning, which obviously charitable planning is a big part of that. But we're also fiduciaries. So we have a legal and ethical obligation to do what's in the best interest of our clients. Obviously, it would be nice if everyone operated under that structure, which you would assume would be the case, but it's not. We don't accept commissions or revenue sharing or anything like that from investment products, which allows us to provide objective advice and again, be very planning focused on the big picture. So we'll get kind of narrow today on the charitable giving side of financial planning and just a few strategies that can really leverage your giving dollars and support the causes that you're supporting, especially Habitat, as we've heard from Dave. But first, what would a financial advisor presentation be without some disclosure? Just back to that fiduciary, standpoint. We can't be a fiduciary for everyone. We're only a fiduciary for folks that we've entered into advisory agreements with. So nothing today that I'll talk about is investment advice. Nothing is tax advice. I am not a CPA. I am not an attorney. But this is for your informational and educational benefit, and feel free to reach out to us with further questions. But just to set the stage, in total dollars given, according to Giving USA, there was close to $560 billion given by Americans to charities last year. Americans are extremely generous. However, if we look back to 2021 and factor in inflation, we've actually been slightly on the decline in terms of pace of giving as a country. Of the $560 billion, about $375 billion of that was from individual donors. North of 80% of that was cash gifts. So closer to maybe an eighth of it was actually given in other assets. And that's one thing that we'll hit on today. That's one way that you can give in a tax advantage way. So, Dave shared that Habitat oftentimes, see the bulk of their revenue dollars, their donations come in after Thanksgiving. And that seems to be the case for virtually all charities across the country. So a lot of that happens towards the end of the year. And we can talk a bit about why. Some of it's just getting clarification from a tax perspective towards the end of the year. So, all right, looks like people are seeing the shared screen. So that's good news. So the strategies we'll talk about today. The first is the qualified charitable distributions. I'm going to call them QCDs throughout the presentation. It stands for qualified charitable distribution. And this happens from your IRA. So this happens from pre-tax dollars. Maybe you had a workplace retirement plan during your working years and you retired and you rolled that money into an individual account, an IRA, or maybe you funded this through annual contributions and took a tax deduction on the way in. But at the end of the day, this bucket, this IRA, is pre-tax dollars. And generally speaking, you're taxed on that money when you pull it out. It's like paying yourself a paycheck, right? So we'll talk about those QCDs as a way to give. We'll also talk about gifts of appreciated stock. So if you've been invested in the stock market in any manner in the last 15 years, you've probably had some appreciation on at least some of your holdings. And so we can talk about a way to use those appreciated securities in a tax advantage way to give. Now, you can give all sorts of assets. You can give privately held stock. You can give cryptocurrency. You can give physical, precious metals or property. Today, we'll really be using an example of a publicly traded stock. I seem to see that most common. It's one of the more liquid ways to give and more common ways of holding an appreciated asset. So as we go through today, we'll talk about publicly traded stock for the most part. And then related to that, I want to talk about a tool you can use either with appreciated stock or cash gifts when you're giving to multiple causes or over time. And so we'll talk about donor advised funds also. But to start with, let's focus on those QCDs, qualified charitable distributions. What is this thing? It's grabbing part of that pre-tax bucket and moving it directly, transferring it directly to the 501c3 charity, such as Habitat. So this is, again, a direct transfer. The check doesn't come in your name. It goes directly to Habitat. It references your name on the gift. But there's a number of reasons that you might consider this. They've really grown in popularity. Especially since the 2016 tax overhaul that was implemented started 2017. Some numbers that I've seen is we've gone from 35% of Americans itemizing their taxes down to somewhere around 5% of Americans itemizing their taxes. We'll get a little bit more into why that's significant. But it's really, I think, boosted the use of these QCDs, these direct transfers. So as some of you may be familiar with, when you reach a certain age in the US, the government starts forcing you to take a portion of your pre-tax retirement savings every year. It's called a required minimum distribution. I promise I'm going to try to keep the acronyms to a minimum today. It's very difficult to do. But these RMDs now start at age 73. It starts around 4% of your account value, just shy of 4%. So you can think on every $100,000 of IRA balance you have, you're generally going to be forced to take about $4,000 of it by the end of the year. Now, the QCD, so enter the QCD. So some folks have their bills paid by Social Security and pensions, maybe portfolio income. Maybe they just have non-retirement assets that they're spending down, and they don't need this forced income. So what they would prefer is to not have that on their tax return, not have that taxable income. And so the QCD is a way to take that or a part or all of that RMD and give it to a charity in lieu of giving cash. What it does is it keeps it off of the 1040 tax return. It keeps it from being taxable income. So there's a benefit to that just on the surface. You don't have to pay tax on that money. But then there are other tax elements at play. As some of you may know, if you hit a certain level of income, it can affect the percentage of your Social Security income that's taxable. If you hit certain thresholds, tax bracket thresholds, that can impact the amount in Medicare premiums you pay. So keeping that quote unquote unwanted income off of your tax return can do even more than just reducing the amount you pay and within the marginal bracket. The other tax benefit goes back to how I mentioned so many fewer Americans are itemizing these days. The 2017 implemented tax overhaul really it took away personal exemptions. It really increased the standard deduction. The standard deduction is always put up against your itemized deductions to see which would be more beneficial to you from a tax perspective. Those common itemized deductions are mortgage interest, state and local taxes, which are now capped at $10,000, and charitable contributions. So it's a way, the QCD is a way for folks that wouldn't add up to more than the standard deduction for those itemized categories to still have a tax benefit from a charitable contribution. Of course, with anything the IRS allows us to do, there's going to be some rules and stipulations. Now, to give a qualified charitable distribution, the individual must be age 70 and a half. And if that age sounds familiar, it used to be the age at which those required minimum distributions started. Those were pushed back in the two Secure Acts that were passed in recent years. It was originally first pushed back to 72 and then age 73, at which time you're forced to start taking that money out of your pre-tax accounts. Well, Congress never changed the age at which you can start qualified charitable distributions. So I'll give an example for QCDs here in a few minutes, and we'll see that even if you haven't reached the age at which you're forced to take the income from the account, it might still behoove you to give from the pre-tax IRA. These are limited. These are limited per individual at $105,000. So it was $100,000 in 2023. It increased to $105,000 in 2024. Somewhat indexed for inflation, that we should continue to see that limit go up. Now, a married couple could give $210,000 between the two of them. Of course, they would each need their own IRA, to do that from. The limit, the 105,000, it's not related to required minimum distribution. If you happen to have an RMD larger than that, you would still have further to go to satisfy your RMD. But for the mass majority of people, your RMD will be less than that. You are not limited to the amount of your RMD, your required minimum distribution for QCDs. You just have to be age 70 and a half. It's a calendar year cutoff, so it must be processed by 12/31. And unfortunately, for some reason, these cannot be made to a donor advised fund. I'm going to give some examples and explain a bit more about that if you're not familiar with donor advised funds. But again, these must go directly to the charity. There are some special limits for some certain charitable trusts and annuity trusts, but for today's purposes, just know that it needs to go directly to the nonprofit. And then if you happen to still be working and have earned income after turning age 75 and you're still stuffing money into the IRA, just know to get with your accountant, because that can impact the amount of the QCD that you can exclude from your income, your taxable income. All right. So if you're interested, you're 70 and a half, how do I pull this off? Well, the first step is to get with your tax advisor. Again, this isn't tax advice. Obviously, this really depends on your tax situation. So you want to make sure that it's going to be beneficial. It's going to be a good use of your IRA distribution. And the other thing is your tax advisor needs to know that you're doing this. Unfortunately, custodians of IRAs do not really do a good job of showing, or they don't have to do a good job of showing that you've done a qualified charitable distribution, a direct transfer. So when you get that 1099-R tax form, the one that shows what's taxable from your IRA for the year, it doesn't specifically highlight that you've done a QCD. You need to make sure your tax advisor is aware of that so that they note it on your tax return. So of course, logistically, you're going to need to know the tax ID and address of the charity. I'm sure Dave would be happy to provide that information to you to get one done for Habitat. Obviously at some point you're going to need to contact your financial advisor and IRA custodian because they'll be the ones helping you process the distribution. And again, it needs to be made payable directly to the charity. I'll just give an example. The clients that we serve custody their assets with Fidelity. So Fidelity cuts the check directly to the charity. It notes the client's name basically on the memo line. And then in most cases, we just have them send it directly to the charity. You can have that check come to you so that you can present the check to the charity, but don't endorse it. It's made payable to them. And then, as Habitat does a great job of doing, you're going to want to ensure you keep that acknowledgement letter or receipt that the charity sends out that they received your gift, just as documentation for the IRS. Okay, so a couple of examples here. So Joe is 75. He has an IRA balance of $100,000. His RMD this year, his required minimum distribution, is $4,065. He normally gives $500 of cash directly to Habitat, and he decides this year, instead of having the RMD fully taxable, to go ahead and cut that check directly from his IRA. So the end result is he's actually reducing his taxable income for the year, which allows him, to be giving on a tax advantage basis to leverage his dollars, especially since he's utilizing the standard deduction. If Joe had instead taken the full RMD, given the $500, still used the standard deduction, there would essentially be no tax benefit or no tax leverage for giving. So Janet is 71. So here's the example of someone that is not quite at required minimum distribution age. She has a healthy $2 million IRA balance. She has no RMD amount this year again, but she's planning for her future required minimum distributions. She also has significant assets outside of the IRA that generate income for her. She's got some fixed sources of incomes like Social Security and pensions that cover her lifestyle expenses. So what she's actually planning for is just starting to tamp down that amount of quote unquote unwanted taxable income in the future. So she can go into that IRA and instead of giving cash, transfer directly, in this case, $50,000 to Habitat. It allows her to do that without any tax implication in that year in terms of paying tax on it, and start to whittle down that IRA balance, again, reducing our future RMDs. It's also a way that she's able to use some, for lack of a better term, tax inefficient assets to give to charity and leave more tax efficient assets like her Roth IRA or even taxable investments to her heirs. The taxable investments would receive a step up of cost basis. The IRA, of course, would be taxable to her heirs upon inheriting. So that's QCDs. So now, and of course, that's for folks that are 70 and a half and up or approaching that age from a planning perspective. The next two really is for anyone. Generally, your order of operations, if you have QCDs available to you, that's typically the best bang for your buck in terms of giving on a tax advantage basis. But if you don't have that in your toolbox because you're not 70 and a half, using gifts of appreciated stock are going to be your go-to. So if you have, shares of companies that have appreciated greatly, sitting in a non-retirement account, you may know that if you sell those at a gain, you're exposed to capital gains taxes. If you've held it less than a year, it's short-term capital gains. Those are taxed at income brackets. Once you've held it longer than a year, you're now exposed to long-term long-term capital gains taxes. And we'll get into kind of what that is. But instead of selling the stock, if you give the stock to Habitat, the 501c3, you potentially have double tax benefit. You get a fair market value tax deduction for the gift, whatever the value of the stock was on the day that you gave it. And you never had to realize those capital gains, right? So you're not paying the capital gains rate on whatever appreciation you had. The higher your income, generally the bigger bang for your buck on giving appreciated stock. And that's just based on our progressive tax system. The top ordinary income tax rate right now is 37%. The top long-term capital gains rate is 20% plus 3.8% of what's called net investment income tax. So just think of that as 23.8 or almost 24% as a long-term capital gains rate for high income earners. Now, a word of caution, there are scenarios where you may not have any tax on capital gains. You'll see here, this is just kind of a clip from our full tax planning reference guide, but single filers can have income of up to $47,000 or married up to $94,000 for filers and not pay capital gains tax. So in these scenarios, and remember, if you sell it, you're going to realize the gain and that might take you over. But in the scenario where you're in a 0% tax rate, it's not going to make a difference. You could sell it and give the cash to the charity, and generally speaking. But once you hit over those income limits, you're either at a 15, an 18.8, because you've got your 3.8 net investment income tax, a 20% or a 23.8% rate, basically. So anyways, so once you're over those income thresholds in terms of taxable income, you're going to have a benefit from giving stock. Before I go too far, and we'll talk about an example here, just know that there are limits to how much you can deduct in terms of the market value you're giving. And it really depends on if you're giving all stock, if you're giving a mixture of stock and cash, or you're giving all cash. So generally, for this discussion, giving of securities is going to be limited to 30% of your adjusted gross income. So just know that there are some cases where, if your income is below a threshold and you give a significant amount in stock, you may end up having to carry some of that charitable deduction forward into future years. If you give cash, depending, it's either 50% or 60% limit on AGI, so it's a bit higher. But assuming that you're well within the AGI limits, on the left-hand side, we see an example of donating stock. The current market value is $50,000. You paid $20,000 for it, so you have $30,000 of appreciation. If you give the stock outright, you basically have a greater tax deduction, a greater contribution to the charity. You give the full $50,000 value. I assure you the charity is going to sell it right away. They don't pay any taxes, right? So they're going to view it almost the equivalent of cash. But you get the greater deduction of giving the full amount. On the right-hand side, if the stock were sold, you'd be paying the long-term capital gains and Medicare surtax on it, 23.8%. You pay about $7,000 in tax. Assuming you net that out, you'd be only giving just shy of $43,000 to Habitat and only have about $15,800 of tax savings in the example. So a couple more real world examples here. So Bill's 55. He can't give a QCD yet. He's got Apple. He's held it forever. He paid $4,000 for the position and it's valued at $50,000. That current market value is less than 30% of Bill's AGI, adjusted gross income, and he transfers the shares directly to Habitat. Therefore, he never sells and realizes the capital gain. He did that because he has lots of Apple and he wanted to reduce his position. So he gives that away in lieu of donating stock. He deducts the full market value. And he actually is doing Roth conversions, which is beyond the scope of this call today. But if you've heard of these or are familiar with it, it's grabbing pre-tax dollars from an IRA and moving it to Roth. So he is marrying this strategy of giving appreciated stock with another tax planning strategy, which is converting pre-tax dollars to Roth IRA to offset the tax implications. So Beth is 40. She's young. She's getting going. She has 350 shares of NVIDIA. If you haven't heard of this company in the news, it's a semiconductor chip design company that has had unbelievable growth over the last several years. She paid $175 for this lot of NVIDIA that is currently has a market value of $5,000. These are real world numbers. She's held it over a year, and the $5,000 is less than 30% of her adjusted gross income. She transfers those shares directly to Habitat. Now, Beth wants to still hold NVIDIA. She thinks there's lots of long-term growth potential still there. So what she does is she takes the $5,000 of cash that she was originally going to give to Habitat and instead gives the shares of NVIDIA and uses the cash to buy the stock back. So what she's essentially done here is hit the reset button on the basis of her stock. So another great example of how to use these would be stock that you have that has unknown basis. Maybe you inherited it, 50 years ago from an uncle, and it was bought before basis was tracked by custodian. There's a great example of a great position to potentially look at giving as appreciated stock. So I know we're running a little short on time here, so I'm going to breeze over just this bonus topic. It's related to appreciated stock, but it's the use of donor advised funds. It's a flexible account created to support charities either now or over time. You can use it if you support multiple charities. You can put in a single contribution and spread that money out over multiple recipients. It streamlines the record keeping in that case. It consolidates your many tax receipts onto one. It's a little easier to track, and you have the option to contribute anonymously. So those are benefits. Some popular examples around this area, you can generally find these at your community foundations, such as our wonderful Dayton Foundation here locally. Their beloved charitable checking account is very popular. That is a donor advised fund. Fidelity is kind of the behemoth in the room. They're one of the largest donor advised fund custodians through their giving account. So these are a couple of examples of where these are housed. So why would you give multiple years worth of contributions in 1 year? Well, here's an example of someone taking that standard deduction. This gets back to how so many more Americans are using this because they're not reaching above the standard deduction with their itemized deductions. In this case, the total 2-year deductions is just the sum of the two standard deductions, the 56.9. If this person were to bunch those 2 years worth of giving into one and do $20,000 in this case in 23, instead of spreading it over the 2 years, they itemize in the higher year with the bunching. They use the standard deduction in the second year, and then they have $7,300 in additional tax deductions. So a wonderful tool to use to bunch those contributions. We'll be sending the slides out, and there's a link to just do a quick calculator online to find out if this tool makes sense for you. So I know we kind of flew through some relatively hairy topics here that get into tax and some complexity. So just know, these are tools in your toolbox, and to discuss it with your tax advisors and your financial advisors to leverage your giving dollars and leverage your impact. You can certainly reach directly out to me and my team. If you have specific questions, I've included my contact information for you. And just to wrap up here, since we're coming up on time, Dave, I think you wanted to talk about Giving Tuesday and maybe even talk about the partnership we'd like to do with you.
Yeah. Thanks, Dan, and really appreciate all the amazing and great information. I've seen people implement as I'm watching the presentation. As a development director, I'm thinking about all the different ways that we receive charitable gifts here at our office, and a lot of people are using these strategies. So thanks for sharing some great information. I also say that I really appreciate Dan being on our team, because he's educated us on some language that we can use and things we can do to share information with donors. And we're really lucky because we've got some long-standing donors, and so being able to share information and strategies with them through some of our communication to better equip them with some of these strategies. So thanks a lot, Dan. And yeah, as we mentioned, kind of starting out, a lot of people this time of year are thinking about whether it be taxes or just giving in general, coming up on Thanksgiving and the holiday season and everything. And every development director would tell you about 80% of the individual giving that any nonprofit receives is usually in November and December, and really between that Thanksgiving and New Year's time of year. So, and to kick that off, here at Habitat, just to give a plug for us, we will be having a really nice Giving Tuesday campaign. Appreciate Birchcreek Wealth Management and his team and Dan. Once again, they'll be matching any donations that we receive on Giving Tuesday. This is at least the second or third year I think it's third year that you guys have done that with in conjunction with us. So every dollar given that day will be matched by the Birchcreek Wealth Management team. So we really appreciate their continued support of that initiative and that tool for us. So thank you for that, Dan, and look for our campaign on our website and social media and email blasts as we come up on Giving Tuesday in a couple weeks. In addition to that, we've sent out our year-end appeal. So I imagine a lot of people are going to be getting this in their mailboxes. Dan just said he got his yesterday or today. I know they're hitting mailboxes this week. So we're really excited about that. Kind of shares out information about our mission, the work we're doing in the community, and how you can support that and partner with us in that work. Beyond that, I just want to say thanks so much. We can't do anything without community support, and it takes everybody helping out. And with that partnership, we're able to change lives. So thank you for being a part of that, and we're here to serve. So thank you.
Thanks, everybody.
Appreciate it.